All right, today we are jumping headfirst into the world of Forex. We're going to break down the absolute fundamentals for you.
Whether you realize it or not, Forex touches pretty much everything. That coffee you're drinking, the car you drive, even that vacation you've been dreaming about, yep, they're all connected to it. So what's the invisible thread tying it all together? What's this financial force that connects a coffee bean from South America all the way to your cup? Well, you've got it. It's the Forex market, and we're about to pull back the curtain on how it all works. First things first, let's talk about the sheer scale of this thing because it is, by a long shot, the biggest financial market on the planet. The name itself, Forex, is pretty simple, right? It's just foreign and exchange squished together. And that's exactly what it is. It's a giant, worldwide marketplace where instead of stocks or commodities, people are trading currencies. And when I say it's massive, I mean it is staggering. We're talking about more than $6 trillion traded every single day. That's trillion with a T. It makes the stock market look tiny in comparison. So why is it so big? Simple. It's the engine of global commerce. It's behind international trade, tourism, even how governments handle their money. Another thing that makes Forex so unique is how it's structured. See, there's no central building, no single place like the New York Stock Exchange. Instead, it's what we call decentralized, a huge global web of banks, brokers, and governments all connected electronically. And because it spans the globe, it literally follows the sun, running 24 hours a day, 5 days a week. As one market closes in one part of the world, another one is just opening up. Okay, to really get a handle on this market, you have to speak the language, and that all starts with the basic building blocks, currency codes and pairs. Every single currency has its own 3-letter code. You know the big ones, of course. USD for the US dollar, EUR for the euro. But traders love their nicknames, so you'll hear people talking about the Aussie for the Australian dollar, or the Kiwi for the New Zealand dollar. It's just part of the lingo. Now, here's a key thing to get. Currencies are always traded in pairs. You've got the base currency, that's the first one, and the quote currency, the second one. So let's take an example, GBP/USD. If the price is, let's say, 1.25, what does that mean? It means 1 British pound, our base currency, is worth 1.25 US dollars, our quote currency. The base is always just 1. And this really gets to the heart of what a Forex trade is. You're never just buying something in a vacuum. You are always buying one currency and selling another one at the exact same time. It's an exchange. So, what are you actually doing when you make a trade? Well, if you go long, that's trader speak for buying GBP/USD, you're basically betting that the pound is going to get stronger against the dollar. On the flip side, if you go short or sell, you're betting the opposite. You think the pound is going to weaken. It's all about that relationship between the two. All right, so we know what we're trading. But how do we measure it all? Let's dive into the nuts and bolts, pips, and lots. In the Forex world, price changes are measured in something called a pip. It's short for percentage in point, and it's basically the tiniest standardized move a currency's price can make. Think of it like a single point of movement. So, for instance, let's say the Aussie dollar is trading against the US dollar at a price of 0.6751. Now, if that price ticks up to 0.6752, boom, that's a 1 pip move. See that? For most pairs, the pip is that fourth number after the decimal point. And believe it or not, it's those tiny, tiny movements that traders are obsessed with. Okay, so if the movements are that small, how do you trade them? Well, that's where lots come in. A lot is just how we measure the size of your trade. A standard lot is 100,000 units of the base currency. But don't worry, there are much smaller sizes too, like mini and micro lots, which makes it more accessible. Now, nothing in life is free, and that includes trading. Let's talk about the most basic cost of making a trade, the spread. Whenever you look up a currency pair, you're not going to see one price, you'll see two. The ask price is what you have to pay if you want to buy. The bid price is what you'll get if you want to sell. Now, the ask is always a little bit higher than the bid, and that tiny gap between them is called the spread. That's how your broker makes their money. It's the built-in cost of doing business. Last but definitely not least, how does a regular person like you or me even get into this massive market? And what's the biggest risk factor you need to know about? Let's talk brokers and leverage. So you'll need a broker to get access, and that broker is going to offer you a very powerful tool called leverage. What is it? In the simplest terms, it's like a loan from your broker that lets you control a much bigger trade than you could afford with just your own cash. The name itself is the perfect analogy. Just like a real lever lets you lift something incredibly heavy with just a little bit of force, financial leverage amplifies your trading power. It lets you make big moves with a relatively small amount of capital. And this right here is probably the most important thing to understand about leverage. It is a classic double-edged sword. Yes, it can supercharge your profits from those tiny little pip moves, but, and this is a huge but, it does the exact same thing to your losses. It basically cranks up the volume on everything, the good and the bad. So that leaves us with a big question, right? For anyone even thinking about Forex, you've got this massive scale, this incredible power tool called leverage. Is it a golden opportunity or is it a massive risk? Well, the real answer? It's both. And just getting your head around that fact, that's the real first step.